Imagine a monolithic entity that owns nearly everything you touch. It is the largest shareholder in Apple. It is the largest shareholder in Microsoft. It owns the bank where you keep your money, the airline you fly for the holidays, and the pharmaceutical company that makes your medicine. It controls assets worth roughly $10 trillion, a sum so staggeringly large it eclipses the GDP of Germany and Japan combined. By all conventional metrics, this entity should be the most ruthless, profit-hungry corporation in human history. It should be run by a cabal of billionaires smoking cigars in a Swiss chalet. But here is the glitch in the matrix. This company does not have a billionaire owner. It has no stock price. It has no private equity overlords. In a legal sense, nobody owns it. And yet, everybody owns it. We are talking about Vanguard. To the average person, it's a boring retirement helper, a benevolent grandfather of finance. But to a growing chorus of contrarian investors and antitrust lawyers, it is something else entirely. A shadow giant that has accidentally broken the fundamental laws of capitalism. We are staring at a paradox. How did a company designed to be a non-profit cooperative for the little guy end up concentrating more corporate power than JP Morgan in his prime? And more importantly, if this giant decides to stumble, does it take the entire global economy down with it? Most financial scandals start with greed. This one starts with good intentions. For 50 years, we were told that the smartest way to invest was to buy the whole market and go to sleep. It was the ultimate free lunch. But in 2019, the man who predicted the 2008 housing collapse, Michael Burry, looked at this passive investing machine and saw a terrifying parallel to the subprime mortgage crisis. He saw a bubble. Not a bubble in a specific stock, but a bubble in the mechanism of the stock market itself. While everyone is distracted by who owns Vanguard, the real story is about what Vanguard is doing to price discovery. We have poured trillions of dollars into a system that buys stocks blindly, regardless of their value. We have replaced the discerning human brain with a mindless algorithm. Today, we are going to tear apart the balance sheet of the world's second largest asset manager. We will look at the circular ownership structure that makes it legally untouchable. We will examine the common ownership trap that might be keeping your airline ticket prices high. And we will simulate what happens when the exit door is too small for $10 trillion to fit through. The question isn't whether passive investing is good for you. The question is, has the cure become worse than the disease? To understand the monster, you have to understand the outcast who built it. Rewind to 1974. Wall Street is a predator's ball. It is the era of the star manager. If you wanted to make money, you paid a guy in a suit massive fees to pick the winners and dodge the losers. It was a game of ego, instinct, and inside information. Enter John C. Jack Bogle. He had just been fired from Wellington Management for a merger that went catastrophically wrong. He was humiliated. He was out of the club. But in his exile, Bogle stumbled upon a mathematical truth that the guys in the suits were desperate to hide. He looked at the data and realised that over a long enough timeline, almost zero active managers beat the market average after you subtracted their fees. It was a zero-sum game where the house, the brokers, always won. Bogle's idea was heresy. He proposed a fund that wouldn't try to win. It wouldn't pick stocks. It wouldn't analyse balance sheets. It would just buy every single company in the S&P 500 and do absolutely nothing. He called it the First Index Investment Trust. Wall Street laughed at him. They called it Bogle's Folly. They printed posters mocking it as un-American. Why? Because if Bogle was right, the entire financial industry was obsolete. Bogle didn't just invent the index fund. He invented a corporate structure that is still unique today. And this is the key to the shadow giant mystery. Look at BlackRock. BlackRock is a public company. It has shareholders who want profits. Therefore, BlackRock has to charge fees to its investors to generate those profits. There is a conflict of interest. Vanguard is different. Bogle set it up as a mutual company. Here is how the circle works. You, the retail investor, buy shares in a Vanguard fund. The Vanguard fund, in turn, legally owns the Vanguard Group itself. There are no outside shareholders. There is no private equity firm taking a cut. The profits Vanguard makes are contractually obligated to be returned to the funds, which effectively lowers the fees for you. It is a perpetual motion machine of cost cutting. In the 1970s, funds charged 2% or 3%. Vanguard drove that down to 0.1%, then 0.05%, then 0.03%. It was ruthless efficiency. By removing the profit motive from the management layer, Bogle created a vacuum that sucked assets away from every other bank on Wall Street. It was the Costco model applied to global finance. Volume over margin. But there was a side effect that Bogle didn't anticipate. When you make something nearly free, people don't just use it, they gorge on it. For decades, this felt like a moral crusade. Jack Bogle became a saint to the middle class. He was the guy fighting for the little old lady in Iowa against the sharks in Manhattan. The Bogleheads, a massive community of devotees, formed around this philosophy. They preached the gospel of set it and forget it. And for a long time, they were right. The math worked. If you bought Vanguard funds in 1980 and held them until today, you crushed the hedge funds. The ethos was democratization. But success breeds scale, and scale changes the physics of the room. Bogle's little experiment didn't stay little. As the 2000s rolled in and the ETF, exchange-traded fund, revolution took hold, trillions of dollars began to migrate. The active managers started dying out. Pension funds, sovereign wealth funds, and endowments all capitulated to the Vanguard model. By the time Bogle died in 2019, his creation was no longer just a participant in the market, it was becoming the market. The underdog had become the Leviathan. By 2023, Vanguard controlled roughly $7.7 trillion. Some estimates for end of 2024 put that number closer to $10 trillion. Combined with BlackRock and State Street, the Big Three, passive funds now control over 20% of the S&P 500 directly. And when you account for all passive structures, the numbers approach 45% of the US stock fund market. This sounds like a victory for the people. We won. We own the means of production. But here is the catch. When you own 5% of a company, you are an investor. When you own 20% of every company in an industry, you are something else. You are a regulator without a badge. You are a king without a crown. The mutual structure meant Vanguard had no outside owners to answer to, but it also meant it had no outside checks on its power. The machine was now running on autopilot, swallowing equity at a rate of billions per day. And as it grew, strange things started happening in the economy. Competition started to soften. Prices started to sticky upwards. The solution to high fees had morphed into a new problem: the silent monopoly. Let's take you inside the room where it happens. A shareholder meeting for a major US airline. The CEO is on stage. In the old days, the crowd would be filled with raucous individuals, union reps, and active fund managers grilling the CEO on performance. Why are costs up? Why did you lose market share to Delta? But today, the room is quieter. The biggest votes aren't cast by people in the chairs. They are cast digitally by a centralized investment stewardship team in Malvern, Pennsylvania, Vanguard's headquarters. Vanguard holds the largest block of votes. But here is the twist. Vanguard also holds the largest block of votes for Delta, and for United, and for American Airlines. This is the reality of the modern economy. The CEO knows that his biggest shareholder also owns his biggest rival. Does he really want to launch a cutthroat price war to steal customers from Delta? Probably not. If he slashes ticket prices to win market share, he hurts Delta's profits. And since Vanguard owns both, Vanguard loses money on the Delta side. The incentive to compete has been chemically removed from the atmosphere. This phenomenon has a name: common ownership. It is the antitrust battleground of the 2020s. Academics and regulators, like those at the FTC, have started to realize that when the big three, Vanguard, BlackRock, State Street, own significant stakes in all competitors within an oligopoly, the market breaks. It's not that Vanguard sends an email saying, "raise prices." That would be illegal collusion. It's subtler. It's structural laziness. Management teams are paid in stock. They know their largest shareholders are universal owners who care about the entire industry doing well, not just one company killing the others. Why work hard to destroy your rival when your boss owns the rival? Research suggests this leads to higher prices for consumers, from airline tickets to banking fees. Vanguard vehemently denies this. They argue they are passive investors who don't dictate strategy. But the data shows a correlation. In 2025, a federal judge in Texas allowed an antitrust case to proceed against the Big Three, alleging they used this massive voting power not just for prices, but to coordinate pressure on coal companies. Whether it's ESG or pricing power, the mechanism is the same. The index fund isn't just watching the game. It's owning both teams, the referees, and the stadium. This is where you, the consumer, get played. You walk into a grocery store. You see Coke and Pepsi. You think, competition. You see 5 different airlines. You think, choice. But if you follow the money upstream, all those rivers flow into the same reservoir. The Vanguard stewardship teams vote on the boards of all these companies. They decide executive compensation packages. If they wanted to, they could fire the CEOs. They rarely do, but the threat is implicit. This concentration of power is unprecedented. In the era of the robber barons, Rockefeller owned oil and Carnegie owned steel. They didn't own each other. Today, the shadow giant owns the oil, the steel, the tech, and the banks. And because Vanguard is owned by its funds, which are owned by 50 million disparate people, there is no single villain to point at. There is no Mr. Burns. There is just a bureaucracy in Pennsylvania following a mandate to match the index. It is the banality of power. So we have a governance problem, a monopoly problem. That's bad enough. But what if the problem is even deeper? What if the very act of pumping trillions of dollars into passive funds is breaking the mathematics of the stock market itself? Enter Michael Burry. The man is famous for being early, being right, and being ignored. In 2019, while the rest of the world was celebrating the bull market, Burry started tweeting warnings that looked like conspiracy theories. He claimed that passive investing had removed price discovery from the markets. He said we were building a house of cards that looked exactly like the CDO bubble of 2008. Everyone told him he was crazy. It's just an index fund, Michael. It's diversified. It's safe. But Burry wasn't looking at the safety of the companies. He was looking at the liquidity of the plumbing. And what he saw was a drain pipe that was about to get clogged. To understand Burry's warning, we have to understand price discovery. Imagine a town market selling apples. In a healthy market, you have active buyers sniffing the apples, checking for bruises, haggling with the farmer. If the apples are rotten, nobody buys them, and the price drops. That is price discovery. Active work setting a real value. Now, imagine a giant truck backs up. Let's call it the Vanguard 500 truck. The driver gets out and says, "I don't care if the apples are rotten. I don't care if they are golden. I have to buy 20% of every apple in this stand because my spreadsheet says so. The farmer realizes this. He stops worrying about quality. He just grows more apples. The price goes up not because the apples are better, but because the truck must buy them. Burry argues that the stock market has become this market. Active managers, the people sniffing the apples, are dying out. They are being replaced by the mechanical trucks of Vanguard and BlackRock. When cash flows into an index fund, that fund must blindly buy the stocks in the index. It doesn't check the PE ratio. It doesn't check the debt levels. It just buys. This, according to Burry, creates a bubble where companies are valued based on their inclusion in a list, not their actual business performance. Here is the technical nightmare scenario Burry identified. It's about the Russell 2000, an index of small companies. Many of these stocks are thinly traded. They have low volume. Maybe a few $1 million change hands a day. But these stocks are included in massive passive ETFs. When you buy a share of a Russell 2000 ETF, you feel safe because you own 2,000 companies. Diversification, right? Wrong. Burry pointed out that a huge percentage of the daily volume in these tiny stocks is coming solely from the passive machines rebalancing. They are being propped up by the blind inflows. The door is the liquidity, the ability to sell without crashing the price. For Apple or Microsoft, the door is huge. But for the bottom half of the index, the door is the size of a cat flap. Burry warned that if the flows reverse, if people get scared and start selling their index funds en masse, the funds will be forced to sell these illiquid stocks mechanically. But there won't be any active buyers on the other side, because the active buyers know the price is fake. It's a setup for a liquidity cascade. The price gaps down. The fund sells more. The price gaps down again. It's a doom loop. Why does this sound familiar? In 2008, the banks took risky subprime mortgages, bundled them together, and called them diversified. They argued that because the mortgages were from different parts of the country, they wouldn't all default at once. They were wrong. Correlations go to 1 in a crisis. Burry sees the exact same hubris in index funds. We are bundling thousands of mediocre, debt-laden zombie companies into shiny wrappers called total market ETFs. We tell retirees these are safe. But just like the CDOs, the safety relies on the assumption that liquidity will always be there. Critics say Burry is fear-mongering. They point out that active traders still set the marginal price. They say the market is robust. But Burry looks at the sheer volume. Passive holding 21.2% of the S&P 500 compared to 3.3% in 2003, and sees a structural fragility. We have crowded into a theatre where everyone is handcuffed together. If one person falls, the whole row goes down. But wait, it gets worse. Vanilla index funds are one thing, but the industry wasn't content with just buying stocks. To squeeze out extra profit and lower tracking error, many of these funds engage in securities lending. This is the dirty plumbing of the ETF world. Vanguard and others lend out the shares they own to short sellers, hedge funds who want to bet against the market. In return, they get collateral and a small fee. This generates revenue that helps keep your expense ratio low. It sounds clever, but it introduces counterparty risk. You don't just own the stock, you own a promise from a hedge fund to return the stock. In a normal market, this is fine. But in a catastrophic meltdown, where hedge funds are blowing up left and right, who has your stock? The complexity under the hood of these simple, passive vehicles is far greater than the brochure admits. And as we entered the volatile years of the 2020s, the cracks started to show. The shadow giant wasn't just holding the market. It was lending it out to the gamblers. 2022 was the first tremor. Inflation spiked. Interest rates ripped higher. For the first time in a decade, both stocks and bonds crashed simultaneously. The 60-40 portfolio, the holy grail of Vanguard investing, had its worst year in generations. This wasn't supposed to happen. The diversification failed. But something interesting happened in the market structure. We saw violent intraday swings. We saw liquidity in the treasury market, the bedrock of global finance, evaporate at random times. Traders reported that the depth of the market was gone. Why? Because the passive giants don't provide liquidity, they consume it. When the market falls, they sell. When it rises, they buy. They exacerbate the momentum. They are trend followers on a galactic scale. While the system didn't break in 2022, it groaned. It revealed that the buffer of active money, the people who step in to buy when things get cheap, had become dangerously thin. The Vanguard fleet was turning the ship, and the ocean was sloshing over the deck. Let's map the feedback loop. When a company like Nvidia gets hyped, its market cap rises. Because its market cap rises, it becomes a larger percentage of the index. Because it is a larger percentage of the index, Vanguard and BlackRock must buy more of it. Their buying pushes the price up further, which forces them to buy even more. It is a self-fulfilling prophecy. This disconnects the price from the fundamentals. Valuation doesn't matter, only flow matters. This works beautifully on the way up. It makes everyone look like a genius. But mechanics work both ways. If a stock starts to fall and gets removed from an index, the selling is forced. Brutal, immediate. There is no human saying, "Wait, this company is still good, let's hold." The algorithm executes. This creates a market prone to melt-ups and meltdowns. It creates a bipolar market. We are seeing fewer steady trends and more violent spasms. And sitting at the control panel of this bipolar machine is a firm that claims it isn't steering the ship at all. Washington is finally waking up with a hangover. For years, regulators loved index funds because they were cheap for voters. But now they see the systemic risk. The Texas antitrust lawsuit against the Big Three over coal is just the tip of the spear. It's a signal that the political protection Vanguard enjoyed is eroding. Politicians on the right hate the woke capital ESG voting. Politicians on the left hate the monopolistic concentration of power. Vanguard is caught in a pincer movement. In response, they have started trying to pass the voting power back to the investors, a program called Vanguard Pilot. They are saying, "Look, we aren't the kings, you vote." But it's a logistical nightmare. Most people don't want to vote on 500 proxies, they just want their returns. The shadow giant is trying to make itself invisible again, but it's too big to hide. The spotlight is burning. Vanguard knows the game is changing. The fees have hit zero. The market saturation is near peak. You can't index more than 100% of the market. And the regulatory heat is rising. So what does an $8 trillion shark do when it runs out of ocean? It evolves legs and walks on land. Vanguard has quietly begun a strategic shift that betrays its original simple philosophy. They are moving into the one place where the regulators can't see, where price discovery is a myth, and where the fees are still juicy. They are moving into private equity. In 2024 and 2025, news broke of partnerships with firms like Blackstone. The shadow giant is preparing to leave the lighted stage of the public stock market and enter the true shadows. And this is where the real danger begins. Imagine a world where the stock market shrinks. Not in value, but in the number of companies. This is already happening. The number of public companies in the US has dropped significantly over the last 2 decades. Why? Because being public sucks. You have quarterly reports, you have short sellers, you have SEC disclosures, and now you have the big three breathing down your neck. The smart money is going private. Vanguard sees this. They announced a partnership to bring private equity to the masses. They want to put regular investors into illiquid, opaque private funds. This sounds like access, but it's actually a trap. Private assets don't mark to market every day. Their value is determined by an appraiser, not a market. It is volatility laundering. By moving trillions into private credit and private equity, Vanguard can smooth out the returns. But they are also locking the exits. You can't sell a private equity stake in a nanosecond on your phone. This is the final transformation of the shadow giant. Phase 1 was indexing, low cost. Phase 2 was universal ownership, control. Phase 3 is privatization, opacity. When Vanguard partners with firms like Blackstone to sell private credit funds to retail investors, they are fundamentally changing the risk profile of the American saver. In a public index fund, if the market crashes, you see it instantly. You lose 20%, you panic, maybe you sell. In a private fund, the market crashes, but the fund manager says, "We haven't revalued the assets yet. You're still flat." It feels safer. It suppresses volatility. But it is an illusion. The losses are real, they are just hidden in the accounting lag. And because these assets are illiquid, if everyone tries to redeem their Vanguard private equity fund at once, the gates will slam shut. We saw this with BRE IT, Blackstone's real estate trust, in 2022-2023. They had to limit withdrawals. Now imagine that on the scale of Vanguard's client base. 50 million people told they cannot access their money because it is stuck in a leveraged buyout of a software company. Jack Bogle is rolling in his grave. He hated high fees. He hated complexity. He hated the idea of private equity, which he viewed as another form of active management fleecing. The new Vanguard is drifting away from its founder's rigid puritanism. It is becoming a normal asset manager, chasing yield, adding complexity, seeking growth at all costs. The current leadership argues they have to do this to survive in a low-return world. They say a 60-40 portfolio of public stocks isn't enough anymore. But in doing so, they are dismantling the safety rails Bogle built. They are inviting the retail investor into the shark tank of private markets. The irony is palpable. The company that became famous for transparency is now guiding its flock into the most opaque sector of finance. The mutual structure remains, but the spirit has mutated. So where does this leave us? We have a $10 trillion entity that owns the public markets so completely that it has broken price discovery. It exerts a gravitational pull on corporate governance that stifles competition. And now, seeing the limits of the public market, it is expanding into the shadows of private capital. We have created a single point of failure for the American dream. If Vanguard holds up, the middle class retires in peace. If Vanguard cracks, whether through a liquidity crisis in its ETFs, a regulatory breakup, or a mismanagement of its new private ventures, the fallout is uncontainable. There is no bailout big enough for $10 trillion. The Federal Reserve can print money, but it cannot print liquidity for illiquid assets. The shadow giant has become the system itself. Vanguard is not evil. That would be too simple. Vanguard is inevitable. It is the logical conclusion of efficient market theory carried to its absolute extreme. We wanted low fees? We got them. We wanted passive income? We got it. But the price was the centralization of capital in the hands of a few benevolent dictators. We traded the chaos of the active market for the stability of the index, only to realize that the index brings its own kind of fragility. Michael Burry's warning is not a prediction of when the crash will happen, but how. It will be a crash of correlation, a crash of liquidity, a crash where the exit doors are welded shut by the very mechanisms that made entry so cheap. The index fund bubble isn't about stock prices being too high, it's about the market structure being too rigid. The next time you check your retirement account and see that steady, comforting growth, remember what is powering it. It is a machine that buys without thinking, a machine that owns the competition, a machine that is now leveraging into the dark. The shadow giant has swallowed the market. It is now coming for the rest of the economy. And the scary part isn't that they are plotting against us. The scary part is that nobody is steering the ship at all. The algorithm is just executing the next buy order. Until it can't. If you want to understand the other titan of this duopoly, BlackRock, and how they are using Aladdin to digitize this control, you need to watch the investigation on Larry Fink next. The system is bigger than one company, and we are just getting started mapping the perimeter.